I'm not so sure central banks are not concerned. So we call it a little bit a balancing act between inflation and growth. And I think there's a lot of discussion in the central banks now how much more to hike. So I think we think there's still more to do from the Fed, but maybe one hike, ECB maybe two. But now we see headline inflation coming down, which I think is really good news. We still think there's sticky core inflation, and that's why I think stop fighting inflation at this point in time would be a bit too early, because you don't want to be in a situation where you're saying, okay, we cut now, we stop it, and then at one point in time you find out core inflation is more sticky and they need to hike again. So from that perspective, not an easy discussion for the central banks from our point of view.
Christian, if there is a view then to protecting economies from recession, there must be a time frame around the hiking cycle. And as we began this conversation several months ago, we were talking about it being a front-loaded program. Now what we're seeing is a slowing in the pace of those hikes, skipping certain months here and there, an expectation that if inflation's still around, then look, we can just come back at it again later this year with rate hikes. Is that actually feasible, given that we're still seeing weakness out of China and some of these economies are going to slow at an even stronger pace later on this year?
Yeah, I think we've seen the Fed now pausing for one, let's say, meeting, and then something to come from that perspective. I think what the central banks will probably do is to do one or two steps, as I mentioned, but then pause. And I think the trigger is more not to cut so early, as some markets are pricing, and now it's moving. The cuts are moving out to next year, which was our expectation. I think that's the way they will go, not to cut too early, but a bit of wait and see mode. And of course, that comes in an environment where growth is not very strong. And I would say markets are a bit priced to perfection here, right? Everyone's saying, yeah, probably we get a soft landing. Central banks do a great job. I'm not so sure there's no downside surprises from that perspective.
Christian, always good to see you, sir. Thank you for joining us this morning. Look, in terms of what the construction of a portfolio looks like at the moment, look, I'm thrilled that our Sparkassen and friends, savers, finally getting a decent interest rate. People investing in yields, finally getting a decent interest rate from those dark negative days as well. That accompanied by the fact that in the past year, the DAX has put on 21% to the upside. Is it time to just park your money in some form of cash-like instrument for short term, just to kind of take in the gains you've had on equities and just ride out any potential storms that you and Karen were talking about?
Yeah, I wouldn't say we see massive storms or crashes in the market. So from that perspective, I think, yes, it makes sense to have some cash at now very interesting yields. And if you look at the absolute level of the yields, they are very high, actually, if you compare to the time after global financial crisis. So that's interesting. However, I think if you would now expect everyone to be able to time the market in the right way, I'm not so sure that's the right investment approach. I think you should stick to your strategic asset allocation and say, is there a change or not? And then I think being invested in the market has already paid out this year. If you think about this, there were so many discussions at the beginning of the year, so many risks. Should I stay out of the market? I think equity so far has done a very good performance. And I think if you miss that, that's a problem. So from that perspective, I think look at your strategic allocation. I think it still makes sense. And it's a positive thing that you get some yield, yes. But I think also you should not, if your risk profile allow, not forget to look at equities, which normally have a positive correlation to inflation.